Welcome back to Iron Financial. I am the lead analyst, and today we are stepping straight into the foundry's furnace. We are bringing you a rigorous, heavy metal breakdown of Taiwan Semiconductor Manufacturing Company's Q2 2026 earnings report. Look, this is exactly where we separate the structurally sound investments from the speculative scrap. If you want no-nonsense, hard-hitting portfolio analysis that cuts through market weakness and helps you actually forge a stronger portfolio, you need to hit that subscribe button right now.
And I am the market skeptic. I am here to make sure we do not get blinded by the sparks flying off these flashy headline numbers. Because today, guys, we have a massive, glaring paradox on our hands. And honestly, it is tearing through portfolios as we speak.
All right, here is the absolute billion-dollar question we have to answer for this explainer today. TSMC absolutely crushed their Q2 earnings. I mean, they knocked it out of the park. They raised their full-year guidance, forecasting revenue growth slightly above 40%. On top of that, they announced a mind-blowing global expansion, literally jacking up their CapEx budget by nearly $10 billion. By every single traditional metric out there, this was a blockbuster lights-out quarter. So why on earth did the broader semiconductor sector and TSM stock itself experience such heavy downward pressure immediately after? We are talking about hundreds of billions of dollars wiped off market caps across the tech sector in the days following this supposedly perfect report. It was a brutal, vicious rotation. We have to ask, is this AI boom a sustainable multi-year cycle, or are we looking at a massive, unsustainable bubble? Are they overbuilding capacity just as demand is peaking, essentially trapping themselves under mountains of depreciation costs?
And those are exactly the cracks in the armor we need to probe today. We are going to hammer out the facts, looking strictly at the balance sheets, the underlying utilization rates, and the specific technology nodes that are driving this colossal machine.
The Q2 report is the absolute foundation of our analysis today. It is the ultimate battleground for the bull versus bear cross-examination. We are going to test the underlying financial steel of this company. There is so much noise in the market right now. You've got panic selling, reactionary downgrades, but we do not trade on emotion here. We trade on data. No hype, no fluff, just the cold, hard metallurgical facts of their financial and operational execution. So let's dive right into this and look at the actual structural numbers that forged this quarter.
The lead analyst, Section 2, Financial and Operational Steel.
Let's methodically detail the top and bottom line figures that forged TSMC's massive quarter. At first glance, I have to say, the structural integrity here looks impenetrable. In Q2 2026, TSMC generated a consolidated revenue of $40.20 billion in US dollar terms. That sits right at the absolute ceiling of their previous guidance range, which was $39.5 to $40.2 billion. Hitting the absolute peak of your own forecast, that demonstrates supreme operational visibility and execution. We're talking about a massive 33.7% increase year over year and a 12.0% jump sequentially just from Q1. Now, turning to the bottom line, net income hit NTT $706.56 billion. That is a staggering, eye-watering 77.4% explosion compared to Q2 2025. Diluted earnings per share hit NT's $27.25, which translates to exactly $4.31 per ADR unit. This company is expanding its core operating power at an accelerating velocity that honestly defies its massive size. Hold on, lead. Let's peel back a layer of that paint for a second. It is way too easy to get mesmerized by a 77.4% explosion in net income, but as analysts, we need to look closer at how that number was actually manufactured before we just go ahead and declare this an unbreakable fortress.
The market skeptic, because if you dig into the non-operating items in the report, there is a massive NT $95.83 billion gain just sitting there. Out of that non-operating gain, NT $63.2 billion came from a one-off disposal and mark-to-market gain on Vanguard International Semiconductor or VIS shares. TSMC sold an 8.1% stake in May 2026. Guys, that is acting as temporary scaffolding. When a company sells off assets to boost net income, it absolutely masks the underlying operational trends in the short term. It definitely gave the net income line an artificial lift. Without that one-off financial boost, the year-over-year headline wouldn't look nearly as explosive. It is financial engineering, plain and simple, not pure core manufacturing muscle.
Okay, that is a fair point, skeptic, and you do always have to separate the core operations from the financial architecture. Yes, the VIS sale provided an artificial lift to the final net income number. I'll give you that. However, even if you completely strip away that temporary scaffolding and look solely at their margins of strength, this operation is wildly profitable.
Their gross margin hit 67.7%, edging past their own forecast of 66 to 68%, and their operating margin rose to 60.3%, hitting above the upper end of guidance.
And to further defend the structural integrity of TSMC here, let's look at the core operating income. For Q2, it hit NT $766.60 billion. Even ignoring the paper adjustments and that Vanguard sale you mentioned, this represents a 65.4% annual increase in pure, unadulterated operating income. That proves the core operations are made of reinforced concrete. They achieve this through higher overall capacity utilization and relentless cost improvement efforts. We are talking about intense automation in the fabs, maximizing wafer yields, and driving extreme efficiencies on the factory floor so that every single ounce of silicon pushed through the furnace yields a higher return on investment. The foundation is incredibly solid, no matter how you slice the non-operating gains.
Section 3. Under the Hood. Technology. We need to shift the debate to the specific architectural makeup of TSMC's revenue to see exactly which technology nodes and platforms are doing all this heavy lifting. When we analyze wafer revenue by technology, the massive pillars supporting this entire structure are the 5nm and 3nm nodes. 5nm commands a massive 33% slice of the total revenue, while 3nm is right behind it at 30%. But the really interesting component of this breakdown, the thing that caught my eye, is that tiny 3% sliver. That is the initial spark from the brand new 2nm technology. They are just starting to ramp up 2nm, and it's already contributing to the top line, which is an incredibly fast monetization of a bleeding-edge process. The legacy nodes, 16nm all the way down to 0.15 micron, make up the remaining 23% balance.
So the absolutely crucial takeaway here is this. Advanced technologies, which TSMC officially defines as 7nm and below, forged a massive 77% of their total wafer revenue. 77%. Now, why does this matter so much? Because nodes that are 7nm and smaller are absolutely critical for modern AI accelerators. When a company like NVIDIA builds their H100 or Blackwell architectures, they require billions of transistors packed into microscopic spaces with incredibly complex heat dissipation capabilities. TSMC is practically the only foundry on the entire planet that can produce these microscopic nodes at a high enough yield and volume to satisfy global demand. This completely reinforces that TSMC's leading-edge tech commands an absolute monopoly on high-end chip production. They are the undeniable, undisputed furnace powering the entire AI revolution. Okay, fine, they dominate the advanced nodes. I'll definitely grant you that. But we need to look at who is actually buying those nodes, because I see some very real structural imbalances forming in their revenue stream that could crack the whole foundation if we aren't careful.
Because when you look at revenue by platform, that is exactly where I see those cracks in the armor. High-performance computing, or HPC, surged 20% sequentially. It is absolutely the locomotive pulling this entire train right now, commanding 66%, a full 2/3 of their total revenue stream. But contrast that against the smartphone segment. Historically, TSMC relied heavily on Apple and the broader consumer phone market as a stable, massive baseline for their business. Now that consumer side is showing clear, undeniable fatigue. Smartphone revenue dropped 4% quarter-over-quarter, shrinking to just 22% of their business. Automotive dropped 5% sequentially to make up just 4% of the pie. They're becoming incredibly, almost dangerously concentrated in HPC and this highly specific AI build-out. The structural risk here is massive. If this AI cycle slows down even slightly, or if major data centers pause their spending for just a quarter or two, TSMC does not have the robust consumer smartphone or automotive markets propping them up to absorb that excess capacity like they used to.
The Market Skeptic. Section 4. CapEx and Cash Flow Paradox.
And this heavy concentration leads us perfectly into a massive paradox. For me, this is the heaviest point of friction in the entire earnings report, and it's likely a major reason why the broader market is getting so nervous about these high valuations. There is a severe disconnect between TSMC's aggressive, almost reckless spending and their immediate cash generation. While operating cash flow looks fine on paper, free cash flow decreased by NT $60.85 billion sequentially, dropping all the way down to NT $287.36 billion. Why is that happening? Because their heavy investment is dangerously outpacing their operating cash flow. In Q2 alone, their capital expenditure hit $15.7 billion US. That brings their first half total to $26.8 billion. They are burning through cash to build foundries at a rate that is frankly terrifying if this hyper-concentrated AI demand doesn't hold up for the next 5 to 10 years.
I hear your concern, skeptic, I really do. But you have to zoom out and look at the massive, multi-year AI demand gap. Management isn't just spending blindly here. They stunned markets by raising their full-year 2026 CapEx budget to an unprecedented $60 to $64 billion, up nearly $10 billion from their previous estimate of $52 to $56 billion. About 70 to 80% of that will go directly into advanced process technologies. Chairman and CEO C.C. Wei cited surging demand, specifically pointing to the rise of what he called agentic AI. For those listening, agentic AI refers to artificial intelligence systems that don't just answer questions or generate text like a standard chatbot, but autonomously execute complex, multi-step tasks across different software ecosystems. That level of autonomy requires significantly more continuous compute power than standard AI. Wei stated this AI megatrend is, and I quote, stronger and stronger. This massive $15.7 billion Q2 spend and the raised full-year guidance are absolutely necessary structural investments. The gap between customer demand and supply is, in Wei's words, very big. They literally have to spend billions today to build the forge for tomorrow, or they lose their monopoly.
The Market Skeptic, Section 5, Structural Debate, Hype versus Reality.
All right, I am taking control of the war room for this structural debate. You say C.C. Wei has multi-year conviction, but I am determined to drill into these long-term risks. I want to grill you on potential overbuilding because I really don't think the visibility is as crystal clear as management claims it is. Let's evaluate this exact quote from CEO C.C. Wei during the call regarding their demand forecasting. He said, "I believe every customer tells me the truth. You put all the truths together, it's not the truth." Guys, this is a cryptic, alarming calculus. What he is openly admitting to here is a classic case of the bullwhip effect. In semiconductor supply chains, panic over shortages causes tech giants to double or triple order just to secure scarce capacity. Every customer, whether it's NVIDIA, AMD, Broadcom, projects massive growth independently. But if you add them all up, it creates an illusion of endless demand that eventually snaps back into a massive inventory glut. How is TSMC verifying actual AI data center deployment? Because if they are building $64 billion worth of fabs based on individual truths that don't add up to macroeconomic reality, we're staring down the barrel of a devastating inventory overbuild.
And look, it's not just a top-line demand risk. I am ruthlessly probing for cracks in their operating margins. Let's look at these structural hazards. First, that 2-nanometer ramp we praised so much earlier. Management admitted the steep ramp of N2 technology in the second half of 2026 is expected to severely dilute gross margins by 3 to 4 percentage points. Second, the Arizona outlay. They just announced an additional $100 billion investment in Arizona for 2nm and advanced packaging, bringing the total planned U.S. investment to an unfathomable $265 billion. You have to ask, is this a necessary geopolitical shield, or is it a massive margin trap? In Taiwan, they have an incredibly efficient, highly flexible labor force running foundries 24/7 like absolute clockwork. In Arizona, they are slamming headfirst into higher construction costs, strict union regulations, and an entirely different labor culture. That severely dilutes profitability. Third, competitor threats from Samsung and Intel are constantly looming. And fourth, TSMC executives showed a very surprising willingness to welcome rival advanced packaging capacity, specifically Intel's EIMIBT, which is Intel's proprietary bridge technology used to stitch different chiplets together. If TSMC is suddenly outsourcing complex packaging to Intel just to relieve their own bottlenecks, they are bleeding potential revenues straight to a rival.
Okay, I will concede that the structural pressures are real, and to their credit, management is completely transparent about it. For Q3, they expect revenue to jump 12% sequentially to between $44.6 billion and $45.8 billion. However, this is the Q3 reality check. Management explicitly expects gross margins to moderate to between 65% and 67%, which is down from Q2's 67.7%. That directly reflects the 3 to 4% margin dilution from the 2nm ramp you just mentioned. But skeptic, you have to remember, this is the traditional TSMC yield curve. Every single time they launch a new leading-edge node, initial margins compress due to heavy front-loaded depreciation and steep learning curves. It usually takes them about 4 to 6 quarters to optimize a new node, work out the manufacturing kinks, and bring those costs down so margins expand back to the corporate average. The Arizona fabs will definitely face similar early margin dilution, but they are critical for locking in long-term Western clients who actively demand geographical diversification.
Section 6. The Ironclad Verdict.
So, we've hammered out the massive revenue beats, we've stress-tested the cash flow paradox, and we've probed the structural risks of their $64 billion CapEx plan. Let's synthesize the bull and bear arguments into a final, actionable conclusion for our Iron Financial viewers. On the bull side, you have an ironclad long-term monopoly.
Executives completely dismissed competitive threats from Samsung and Intel, emphasizing that building the trust and technology TSMC has takes years, if not decades. Their massive investment cycle creates an unbreakable long-term moat, because for high-end AI chips, they're essentially the only game in town. But on the bear side, you have near-term margin dilution from the 2-nanometer ramp and the Arizona expansion. And more importantly, you have a deteriorating scarcity premium. Think about it. Over the last year, investors were paying a massive premium because TSMC was the only foundry with available capacity for these chips. But as TSMC spends $64 billion to build more fabs, supply naturally starts to catch up. When supply catches up, that scarcity vanishes, and price-to-earnings multiples often compress even if top-line revenue continues to grow. If CCWay's truth calculus is wrong, that capex bill is going to crush their free cash flow for years.
Regardless of the long-term macro narrative, we have to respect the immediate price action and the critical structural floor sitting between $383.50 and $394.88. If that support zone breaks, the technical damage to the chart will be severe and could accelerate downside momentum. For the bulls to regain control of the furnace and reverse this recent sell-off, the stock needs to aggressively reclaim the EMA band near $433. Until we see a decisive break above that level, expect heavy volatility. And that is our deep dive into TSMC's Q 2026. The financial steel is incredibly strong, but the heat is rising, and the margin pressures are undeniably real. Thank you for stepping into the foundry with us today. Hit subscribe, stay disciplined, and we will ask you this: do you have the stomach for the foundry's heat? We'll see you on the next Iron Financial Explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.